Welcome, everyone. I can see that people are trickling in. We're at 47 going up, so I'll just wait a few minutes before I start. Okay, so we've plateaued at 65. Great. Well, welcome, everyone. We're super excited to have you for this first webinar called Improving Profitability, which is the first in a 6-webinar series that we, the ILO, are doing with the Microinsurance Network and with the support of the Generation Foundation. As you know, the series is called Learning from the Leaders. So at the ILO's Impact Insurance Facility, hopefully many of you have heard of us, our mission is to enable the financial services industry, governments and their partners to realize the potential of insurance for social and economic development. The Microinsurance Network has a similar goal and is committed to building a world where people of all income levels are more resilient and less vulnerable to daily and catastrophic risks through improved access to effective risk management tools, including insurance services. Now, to realize these goals of inclusive insurance, this is inextricably linked to profitability and more generally financial sustainability. So without this, there is no financially viable insurance solution. So attaining profitability or financial sustainability, which I keep adding since not all inclusive insurance ventures are for profit, you have mutuals and takaful insurers and community-based schemes that also need to be financially sustainable. So profitability and financial sustainability are very important to the longevity of inclusive insurance schemes. We have therefore asked 2 leaders, both of whom come from well-respected and leading inclusive insurers, to share their insights on the secrets of profitability. So what I shall first do, please excuse my voice, I have a bit of a cold, is I'm going to introduce to you the speakers, and they will each speak for around 10 minutes. If you can keep your questions, we'll have time for a Q&A at the end. Then you can please put your questions in the chat, and we will take it at the end. So let me introduce our first speaker, who is Lorenzo Chan Jr. Lorenzo is president and CEO of Pioneer Inc. in the Philippines. He is a cum laude graduate with a double degree from Fordham University, with extensive experience across both the general and life insurance sectors. He has been at the forefront of innovative solutions such as developing sachet insurance tailored for middle and low income markets. Under his leadership, Pioneer has led the microinsurance sector, counting over 30 million enrollments in 2024. He is a strong advocate for inclusion and has co-authored a book about Card Pioneer's microinsurance journey. Beyond Pioneer, Lorenzo chairs the Microinsurance Network and is a member of the World Bank's CGAP Advisory Committee on Climate Resilience. So, Lorenzo, I'd like to welcome you, and I'm going to put up your slides. So, over to you.
Thank you. Thank you. Right. So welcome, everyone. I'm in the interest of time, going to go right on and proceed. Next slide, please. I think what we'll cover today, you will find out. So I'm not going to take you through this slide to save about 35 seconds. Next slide, please. All right. So it's an open secret towards sustainability. As Lisa mentioned, when we talk about sustainability, that is the all and end all, isn't it? I think other people refer to this as profitability, but sustainability applies for everyone, whether you're commercial, a publicly listed company, or you are mutual. And we've always said it must be very clear the why. Why are we doing this? Why is anyone doing inclusion or microinsurance? There's got to be a clear rationale. And so far as Pioneer is concerned, we wanted to grow our market share. We wanted to be the insurer of choice. And like in every other market, if you want to achieve that, you really go down the pyramid where the numbers are bigger, and that will provide you some scale. So that's got to be very clear. What are we prepared to do? Which it's really a commitment, isn't it? The willingness to stay the course despite challenges. And we will all go through challenges at the onset. And then sometimes you still go through challenges, even if you've been at it for quite some time. It's just that the challenges vary. And so you will have hard times when we started our foray into micro in 2008, but our big challenges came in 2013 and 2014 with successive earthquakes and massive storms, including Haiyan, and that brought us to the red. Without a clear commitment of wanting to keep at it, one could easily have just bailed out, but we did not. And today things have changed drastically. And as Lisa mentioned, we counted about 30.9 million enrollments at the end of last year. And then go beyond the business case. Everyone keeps saying, is there a business case? Is there a business case? And I keep saying, yes, there is. Yes, there is. But for you to have a good chance of making a go of it, you have got to look beyond the business case so that it keeps you going. It serves as a North Star if things go a bit south, if you suffer a bit some big losses, you're able to keep your eye on that. Otherwise, if you just look upon it as a pure business case, you're going to say, oh, very few people buy it. It's not interested, or lots of losses. It's not worthwhile. Then we'll pull out. Then that doesn't make sense. And what you do if you actually go through these moments, you've got to continue to innovate and recalibrate. Clearly, we cannot do things the way we do traditional insurance, and so it's got to be quite different. And each time we try out something that doesn't seem to work, we've got to recalibrate quickly. Next slide, please. And so, yeah, achieving critical mass. How do you do that? Partnerships are the way to go. Insurers themselves don't carry the greatest credibility with the public at large, and so you've got to partner with entities and organizations who the target market trusts. And so for us, it's MFIs, pawn shops, remittance agencies, motorcycle dealers, etc. Claims is number one. It's the most important value proposition. That's what we are pushing, isn't it? Claims, claims, claims. Pay claims, pay claims, pay claims. And quick claim settlement builds trust and earns ourselves credibility with the market. Innovating the 6 Ps, and that's really product, price, place, promotion, people, and process. It's quite a great deal. I think we actually had to innovate in all 6 Ps, but maybe the standouts for us are the process. We decided that we would do 135, target settlement of claims within 1 day from occurrence, and if we need more info, within 3 days, and within 5 days with finality, settlement or a declination with explanation. Today, this has been shifted to 8 to 24. We're now targeting settlement within 8 to 24 hours. We've also, because we had to keep it cost neutral and effective, we've also trained some of our micro agents on the ground to be claims adjusters, not of their own claims, but of each other's claims. So there is that bit that helps us to be speedier in our response. And then, of course, listen to the target market. And we always leave the office, go out to the field, and talk to the target market. We focus on the customer, not the product, because we certainly believe the customer knows what they need. Next slide, please. Okay, how do you balance cost and premiums? I mean, it's always a challenge, isn't it? Oh my God, it's so expensive, etc. When we started this, it was a big company, and so we shouldered a lot of the costs ourselves. But when Pioneer eventually went into a joint venture with the largest microfinance institute in the country called CARD, we decided we would each partner would shoulder their cost of shared services. So Pioneer would shoulder the cost of product development, IT, all the technical stuff. CARD would shoulder the cost of distribution, the cost of claims adjustment. So that way, we did not weigh down the newborn baby, the joint venture, with a lot of operating costs. So it gave it a chance to learn how to walk and breathe. And today, of course, it's shouldering a whole lot of it already because it can walk on its own, it's self-sufficient and sustainable. Okay, compete differently. For me, it's a favorite thing, isn't it? You cannot just compete on give low rates and high commissions. We know that doesn't really work on a long-term basis. And so you've got to look for ways to convince people why they're doing this, why a partner should take on insurance. And for us, it very often just means convincing them we could create a new revenue stream for them that's not based on commission. And for instance, for the motorcycle distributors, we just said that whoever buys this cover, if they need it repaired, we refer all the repairs to you. So that's a new stream of business, repairs, spare parts again. So it allows them as well to continue enhancing their offering. So compete on a different scale, and one can easily do that. Test, review, and calibrate. Some things will work and some things will not. And so what doesn't work, then you have to decide, do you reprice it? Do you redesign it? And other things work very well, but sometimes there's a very low loss ratio. So what do you do? I mean, that shouldn't be a problem, but it is a problem in the world of inclusion. We enhance the product. We give more. We enhance the coverage. It's a wider coverage for no premium increase. Or other times we work with other means. There's a whole stream of things you can do to continue to add value. But maybe we can do that in the Q&A. Next slide, please. It's important we secure support from those who matter. And you're talking about the big wigs, yeah? The board itself, the senior people. And to do so is not hard, but it's not necessarily easy. It's not as simple as going to them and saying, I want to do this. So when we did it in the Pioneer side, I actually related it to the corporate vision. If we want to be the insurer of choice in the markets of choice sustainably, hey, you've got to widen the client base. And where do you do? But go down the pyramid to those who actually need it. So that is tied up with that choice, isn't it? Two, communicate to them in language they understand. And it's great to talk about inclusion and helping and empowerment and impact, and all that is valid, and they will appreciate that, but not immediately. I mean, for them to be convinced to give this a go, what do you say? I mean, then what does it mean? So I still relate it to them in terms of what it means with premiums and ratios. But we also told them, but we also have to start measuring number of lives, number of enrollments, turnaround times of claim settlement, because all that is very vital. So we've in fact added stuff that we will look at, in language, in words that they could grasp and understand. And they're most of the time willing to give it a go. Next, it is keep preaching and testing. Delivering a few quick and early wins is always useful because it shows that there is some progress. Oh yeah, there is some response. There's a good chance. It keeps up the momentum. And so when we did this in the beginning, we didn't put all our eggs in one basket. We tried different products. We tried different channels of distribution. And then we also tried out partnerships. We had quite a few failures, but the partnerships worked very well, and that immediately gave us a few extensions. In fact, one of the things I remember going to them on was I said, I want to be able to sell motorcycle, and because that was anathema to a traditional business model. They wanted motor cars, but not motorcycles. They think people cannot understand, are bad risk, et cetera, et cetera. I said, no, we cannot do this because these people we're trying to reach will not be able to afford cars, but they can afford motorcycles. And that has made a world of difference. Today, we count about 15 partnerships across the motorcycle segment, and we write annually about 400 to 500,000 motorbikes. Okay, so those were quick wins that allowed us to keep the momentum going. And then just couple more slides. Next slide, please. Yeah, I mean, I just thought this was useful because people kept saying, okay, profitability and sustainability. So you can, what is in blue are the premium levels, what is in red are the enrollments, and what is in pale green are the claims paid. And so, yeah, you can see that it's been on a very decent upswing. And so yeah. Today, we're talking about roughly 2024 had about $71 million in premiums and over 30.9 million enrollments and about 27 million in dollars in claims. But don't worry about the low loss claim ratios. We have done quite a bit of effort as well as in enhancing that. So you can have in Q&A. Okay, so my last slide is really a quick issue of the takeaways. Profitability and sustainability, either way, require a clear rationale. Know why you're doing it, a commitment, a focus, so that you keep your eye on the ball. And we've got to innovate and recalibrate as necessary. Partnerships and trust building and customer focus are essential if we are to earn credibility and scale. Management and sharing of costs and roles are essential, especially at the onset. You don't want to saddle a new product or a new joint venture with tons and tons of regular costs. And of course, a few early wins are necessary to convince your board that it is worth pursuing. Thank you very much.
Thank you so much, Lorenzo, for those pearls of wisdom. I mean, to have 30 million enrollments in 2024 alone is pretty impressive. So I hope that everybody was listening, because these things might sound maybe obvious, but sometimes it's the obvious things that people don't do. So thank you. I hope that you enjoyed Lorenzo's presentation. Please put your questions in the chat. Just to say that we actually do have Spanish translation. So if there are any Spanish speakers who are listening, Nicholas has put in the chat what you need to do. So I am now going to introduce our second speaker. So our second speaker is Quentin Gisserot. So Quentin is co-founder and head of partnerships at AXA EssentiALL, a business created in 2016 to ensure underserved customers around the world can access protection for their families, businesses, and communities. As at the end of 2024, AXA EssentiALL protected over 15 million customers in 20 countries, so also a large, large number, definitely reaching scale. So before this, Quentin advocated the AXA Group's position on public policy and societal issues, notably the 2015 Paris Climate Accords, and contributed to She for Shield, which is the first global study done with the IFC, which spotlighted women as a strategic client segment for the insurance industry. Quentin is a graduate of the Sorbonne University and the Institut d'études politiques in Paris. So Quentin, warm welcome to you. Thank you so much for joining. I'm going to put up your slides. So if you would like to put on your video, it's over to you.
Thank you, Lisa. Does the video work?
It does work. I can see you. I can hear you. All is good.
Wonderful. Thank you, Lisa, and thank you as well to the Microinsurance Network teams. Because from the start, from when we started in AXA focusing on inclusive insurance, it was really extremely precious to learn from everything that had already been learned and developed by both of these institutions. So thank you for putting together this series. I just wanted to tell you in a nutshell about AXA EssentiALL, because our focus is a little bit different from Lorenzo's. We're a bit more global. We're also in the Philippines, but it's a focus which we've extended in more than a dozen markets in Asia, Africa, and Latin America now, and even actually in Europe. And I'll get back to that in a second, because we often think that inclusive insurance is really mostly for emerging economies, but actually there are needs in Europe and elsewhere as well. But in a nutshell, we're really also on the same journey, really protecting people without access to traditional insurance. The one thing where I can maybe add is most of you probably listening into this webinar are working in geographies where insurance remains the exception, where most of the policies that we strive to sell are often the first or the second policy that our customers are purchasing. In Europe, the challenge that we have is a little bit different. But there is still one, and we're trying to access it, to address it. Sorry. The challenge is that we kind of have people who are in the middle class and who are facing more and more purchasing power challenges. Their salary is not following inflation. Their constrained expenses are going up and up and up. And so these were people who were insured all their lives, but now they're sometimes forced to make budgetary arbitrations and maybe insure themselves less, or even give up on insurance, even when it's mandatory. In many of our countries, and France in particular is quite insurance heavy. And so we kind of saw the necessity to kind of also address inclusive insurance in Europe, and not just the emerging economies, which you see on the right. This being said, there's a lot in common, and I think these are some of the learnings that we had as well. profitability in particular for today, but more broadly generally. If you can go to the next slide, Lisa, please. AXA EssentiALL, it was called AXA Emerging Customers in the beginning when we were only focusing on emerging economies. It's a business we started 10 years ago, as I was saying, in the beginning in 4 markets, and then progressively we added additional countries, etc. There's been ups and downs. One big down was when, unfortunately, we decided to close our operations in India, more broadly than inclusive insurance, but that's the big hit that you see in 2020. But overall, what we see is that, if you're patient, and I think this is a word I keep from Lorenzo's presentation, it's a patience game. But if you're patient, it can work over the long term with a specific focus. So today we're reaching around 15 million customers at the end of last year, and we're able to do that on a profitable basis because the global combined ratio of the activity is at 91%. That's a 2023 figure, and 2023 figure. And you can see the premium amounts here. So really with the average premiums that are around 2 euros a month. So the learning from this one is it's possible, but it requires time and focus and patience. Maybe if you can switch us to the next slide, Lisa. If we focus on the topic for today, which is profitability, and actually, I agree with Lorenzo. I think the term sustainability, it depends on the context, right? If you're speaking to your CFO, profitability is probably a good term to have. If you're speaking to impact investors, maybe you need to, or donors, etc. Maybe sustainability does the job, but I agree that we need to have both legs, the impact and the profitability. But the key word on this slide that we wanted to highlight is there is no silver bullet in inclusive insurance. And I mean, even in one country, you have very different realities, but we're present across 3 continents, even more, across several types of lines of business, and we distribute the products through multiple distribution channels. So overall, we have this 91% combined ratio, but if you deep dive, there's a lot of diversity in situations, etc. Of course, many of you around the table, know that inclusive insurance, it's a scale game, right? You need to reach many customers so you're able to make a profit, or at least be sustainable on a very low average premium per customer. But there are products which are smaller or larger than others. If you want to have a very impactful health insurance policy, is going to be more costly than an accident policy. The average premium on a crop insurance is going to be higher than on maybe a very simple fire insurance. And so it's really about starting from the segment, starting from the needs, and starting from the ability to pay of the customer segment that you're looking at, and taking it from there. Because if you take it from there, you're able to build up the volumes, and from the volumes comes really the sustainability of the scheme. Several things. So we've got this 91% average combined ratio, but it hides many different realities. We have actually almost 1/5 of our schemes, so around 20%, in which the combined ratio is at 100% or higher, which in insurance terms means that you're technically, well, on the technical side, on the insurance side, you're losing money. Is that a bad thing? I think we have to go beyond the numbers. We have to look at the context. First, you have many markets in which, even with a combined ratio above 100%, you can still be sustainable or profitable because you still invest the premiums and get money from that. But maybe more importantly, you have some lines of business or some distribution channels where you know that structurally the profitability is going to be a bit tighter. When you're working in public-private partnerships, when you're working in agriculture insurance, you know, the average premiums are the average premiums for one, but also the average combined ratios, the profitability indicators are going to be a bit tighter than maybe if you work with microfinance institutions, etc. And so really we see this diversity in the results. I guess the question over there is, what are we, you know, why are we in these schemes for? There are some schemes where it's perfectly okay for us in AXA to be break even or even lose money, but there has to be a silver lining at some point. There has to be either a perspective for future sustainability. So in the beginning, you can have a scheme with a lot of, you know, implementation costs. It has to get up and running, etc. But you want either to be learning something from this scheme, or you want to be able to turn it around because you'll have more volumes down the line. And this is really dependent on the local context of the scheme. So context and patience is probably what matters on this slide. If you can go to the next one, Lisa, please. I wanted to highlight one example. And I mentioned in the beginning that, you know, we had extended our inclusive insurance activities beyond Africa, Latin America, and Asia to Europe. And so I thought, you know, it could be useful to give you one example of one scheme in Europe and how we thought of, you know, combining the social impact with the necessary profitability. And the scheme is about one specific target. It's in France, and it's about micro entrepreneurs. So here in France, every year you have around 700,000 new micro entrepreneurs, micro enterprises. So it's really a one-person business. You can have quite a wide diversity of types of professions. It can be a small restaurant, you know, it can be a service business, but it has to be a one-person business, and it has to be a small business. So you can't have a top line above 100,000 euros. And so usually the challenge is that for these very small businesses in France, they're underinsured. Almost half of them, you know, they don't have any form of property insurance. And the stats is slightly below. It's 40%. 40% of micro entrepreneurs, they hesitated to start the business because they didn't have, you know, social protection like they would have had if they were an employee. So there was definitely a real customer need. The question is, how do we build something which makes sense while remaining sustainable in a market like France with high levels of cost? And so the design we came up with was this micro entrepreneur pack, which is a combination of several covers. So it covers the liability of the entrepreneur. It covers the damage either made to the shop if there's a physical location, or, you know, to whichever professional assets that person may have to do their job. And perhaps more innovatively, it also covers people if they have a legal dispute and if they are unable to work, notably because of a hospitalization or an accident. So it combines a little bit of property and casualty insurance with a degree of protection insurance. And the consequence of doing this is it's a packaged product. So you have to take the whole deal. You can't take one product versus the other. And that's really part of the answer on profitability here, because by doing so, we limit the anti-selection. We limit the chances that one person would take one coverage because they think they're going to use it more, which is typically a challenge in protection insurance in France. The second thing is we're bundling things together. So we're also saving the cost versus having three policies, each on their side. Thirdly, what makes this product cheaper but still sustainable is we've managed to negotiate reduced distribution costs. So typically, an agent in France to sell professional insurance takes 20% commission. Here, the commission for this product is 14%, 1-4. So we negotiated a 6% drop in the distribution commission, which was not easy, but which was made possible because it's a very easy product. It's got no underwriting. The price is the same for everyone. So since it's a very basic product, and this is really the characteristics of inclusive insurance generally, well, the distributors accepted to take a lower fee, a lower margin for distributing it in exchange for AXA lowering its own fees. And AXA lowered its own operational expenses because for us as well, it was simpler. We had one policy, the terms and conditions had been rewritten and simplified. The claims and the amounts of coverage are very flat amounts of coverage. There's no complicated calculations to be done. And so I think this product is a good example of where you can kind of try to save on the entire value chain. You try to design something which is purely focused on the needs of the customer. So you take out any additional frills that may not be necessary. You try to distribute it in the cheapest way possible, and you try to manage and operationalize it as well, by saving costs. And the consequence of that is typically professional insurance in France starts at 600 euros. Here we're able to do something at 350. And it's the same reality in emerging markets that we have. I guess, in conclusion, if you're thinking about profitability, you have to think about how you combine a product which is impactful with a product which makes economic sense. You have to be patient, and in the end, when I say you have to be patient is, I guess over time you're going to build the insurance culture of the customers, but you're also going to be able to do things cheaper. And the final thing is you have to really be aware of the context. So the answer here for France, this is a product which was distributed in one specific channel, which is agents. If we had distributed through banks, maybe the answer would have been a little bit different. So it's really about contextualizing, patience, and as Lorenzo was saying, combining profit with purpose. I think that's really what drives the sustainability here. I think Lisa, we can maybe keep this one, for later. I guess the sense of this one was the patience game, right? Showing that it wasn't built overnight. This is almost 10 years in the journey, so we can get back to that maybe in the discussion. But I want to leave time for questions.
Fantastic, thank you so much, Quentin. That was an excellent presentation. Again, at the ILO and the Microinsurance Network, we've been doing a lot of research on profitability, and that was a fantastic summary of some really important points. I'm going to put my slides back up for our Q&A. So we've got some fantastic questions. There we go. So let's dive into them. The idea behind these webinars is that we have, enough time for some good Q&A, because that's a lot of the time what people really value. So this first question from Thomas, I'm going to slightly change the wording. Hopefully I'll get it right. So Thomas says, so the best approach or the best business model is to test, review, recalibrate. So I guess that's about the iterative approach, but he wonders about how to align the model with the regulatory environment related to product approvals. So I hope that question is clear. But would either one of you like to answer, like how do you test and get things out when you've actually got regulations that might get in the way?
Okay, let me try and go at that.
Okay.
When we started to do microinsurance and tested it, this was 2008. There was still as yet no definitive microinsurance regulation as yet. They only had mutual benefit associations, and that was the extent of microinsurance. And so when we launched our products in 2008 and 9, the guidelines, the formal guidelines came up in 2010. So what we did was we approached it in the way we knew how, which was what we thought was the ongoing product approval process and what would be allowed, et cetera, et cetera. So that's how we went on. The only thing we did was we made sure that the coverages were much, much lower, the premiums were much, much lower, and the processes were much far simpler. And so, of course, the insurance commission, they approved it. Now, subsequently, when they came out with the guidelines, they said, okay, you've got to apply this. So what we did is we said, we will apply as we are committed to, but you cannot stop us from selling the products we've already sold, because that's what the market is accustomed to, etc. We will, however, shift into incorporate the new guidelines, and that's not been an issue, and that's always that's always worked. And I don't know if that's also because very often we're about one step, two steps ahead, and so we're able to sort of adopt it. So that's not an issue. Quentin,
would you like to add? I mean, you work in a number of different countries, so
yes.
Is it also about working with regulators? What do you think?
I guess not everybody is as fortunate as the Philippines, to have a specific framework. But I would say several things. I would say first, it's gotten better. In 10 years, if I take a country like India, it's much easier to approve a product now than it was before. The second thing is, you said it yourself, Lisa, go speak to the regulator. More and more of them have the mandate to drive this. I think sometimes, we impede ourselves from having an open conversation, and it's everybody's trying to push in the same direction. And the third and final thing is, try to be smart with the constraints that there are. If it takes a long time to file a product, try to file it as openly as you can. The number of times I've seen, in the beginning when we were filing products, we were filing something extremely specific. So it was a term life, but it was filed for one specific channel. And so if you were changing the channel or if you were slightly changing the age, you had to redo everything. Try to file the products as openly as possible.
Great, thank you.
Lisa,
yes, Lorenzo.
I don't know if people are coping with, when you do micro, you try to simplify products and the processes and the wordings. However, you have compliance issues with it. All over the world, we have KYC, we have the AMLC, the anti-money laundering bit, and that threatens always to take back whatever gains we have with simplicity. And so the way we did it in the Philippines was that we went straight to the regulatory authority and says, please do not do this. Do not subject people who give us $2 worth of premium a year to 3 pages of KYC and anti-money laundering compliance. In fact, I said, we all know the only thing they launder are soiled clothes. And to this day, we have managed to stave off that bit, and we've also managed to keep the information data fields we require from our clients down to 7 information fields.
That's fantastic. Great. Thank you. So let's go on to question 2, because we've got quite a few questions. So for both of you, what are the most profitable products that you have, and which ones are not? From Philippe. So yeah, Quentin, you had that wonderful chart. So I don't know if
I can maybe tell you that there are some products for which you have to look at sustainability differently. So you have some products like life or health or accident, where 1 year should be comparable to the next, right? I mean, of course, there's COVID and things like that, but you're looking at profitability year on year. You have products where, like, if you look at crop insurance, that there is going to be 1 year when you're going to have a big claim, and then that ought to be compensated, by the other years. So first, really keeping that in mind. Second, it can take time also in inclusive insurance, microinsurance, for customers to fully understand, the products and how to claim, etc. So it can also take, and we've seen the opposite problem, right? We've seen products which often are too profitable, So there's not enough claims. That's the signal that people are not fully using or understanding the product, and what are you going to do about it? And finally, if there is a government involved, you are quite likely to have pressures, and it's especially if there's public money, that you won't get away with making huge amounts of profits, and that's fine and quite legitimate. If you look, for example, at the Indian agriculture insurance scheme, I was just discussing this one yesterday with someone in India. They've now implemented a rule where if the loss ratio is under 80%, you have to reimburse the difference to the government, who is the payer. But conversely, if it's above 110, the government keeps the losses. So it's quite an interesting setup, right? And it's a different way of considering the public and private collaboration.
On my side, definitely not profitable agriculture. Up until we did agriculture, the only agriculture product in the market was offered by the government. There were 52 private sector companies. No one did agriculture. And so we responded to the call to do micro-agri. And so it's had a bad loss ratio year after year because naturally it covers flood and typhoon. And so the people who buy it are people in flood and typhoon prone areas. And so the people who are not say, I don't need it. And so we've now worked on this to include drought, et cetera, et cetera. So we'll see how that goes. But we remain committed to it because, as Quentin says, there are certain products that you give a longer leash. There are certain products that you sort of are committed to. Well, I mean, food security concerns, the people who put food on our tables. I mean, isn't that something we ought to all be responsible for? And so that's something we're very committed to. However, there are all the other products that seem to be doing okay. And a number of the other products, like what Quentin mentioned, you bundle them. So we have one of our best sellers is a product that has accident and burial and property damage arising from flood, typhoon, earthquakes. And so there are years that the earth, that with the earthquake or the flood cover, it shoots through the roof. But then the PA, the accident, and the burial sort of offsets that. And so all these seem, all that works, quite well. But by and large, I think it's agri that's a challenge, but we remain committed to it. All the others, I mean, there's really it's actually quite decent. And again, I know that there are certain practitioners who obsess over claims ratios, and they get find it very difficult if it's too low. Well, give them more cover. I mean, that's what we did. At the start of the pandemic, we doubled the cover of hospital cash, and we also made a pronouncement that it will accept COVID patients, and with a very minor increase in premiums. And so the sales went up, but the losses went up. But you know what? Post-pandemic, they rewarded us. The sales for that product are terrific because people know that you are there with them.
There's always something that can be done. That's great. And I think so many moving parts. So it's interesting to hear your answers. So now I'm going to change the rules a little bit. I'm going to give one question to Quentin and one question to Lorenzo. Okay. So Quentin, the question for you, how do you ensure or strive for profitability, especially when in the emerging markets, the majority of the population is poor? That's a question from Moses. And Lebohang has a question for you, Lorenzo. I'm just going to randomly give it to you. What happens if demanded products are low margin products, yet expenses are still the same? How is profitability improved? Okay, I hope those questions are clear. So, Quentin, go for it.
Yeah, I mean, it's a good question. I would answer, back to the pyramid we had in the beginning. Many people are poor, but not everybody's poor, and there are many people who are not poor, but who are not insured either. They're on their way to the middle class, but they're one risk away from falling back into poverty, and that's the segment that many people are looking at. So I think the reason we didn't structure it as a charity is because we want sustainability. We want our local CEOs in AXA, to have this on their roadmap, to see this as an alignment of their own, corporate interests and not something that they do on the side, if we want it to happen at scale. I think that's one of the realities. The second reality is there are some people who are below poverty line for sure. But some of them, they will still take up the products that we offer, which even though they may be targeted slightly above. But there are other schemes, sometimes run entirely by the government in social protection, but sometimes also public-private partnerships, where you can have subsidies come in for these customers. And even in France, you have complementary health insurance. If you're below poverty line, it's paid for by the government, even if you take it up from a private insurance company. So that's where we see the conundrum, but that's where we see the answer to the conundrum. But I wouldn't say that, nobody's saying we maximize profits. We're trying to maximize profits or even look at the same levels of profits on every scheme and versus the traditional business.
Thanks, Quentin. In our research also, we come across insurers that just aim to kind of break even because they kind of see this as a very long-term game. Right, Lorenzo, the question from Lebahang.
Right. You've got to work on volume and scale. Got to work on volume and scale because insofar as we're concerned, just about all our products in micro are relatively low margin products. We don't, and of course you keep your expenses to a minimum as well. For instance, one of the best selling products we had in the very, very, very early days costs $5 a year. And it gives out $2,000 of cover for accident, $600 in burial, and $200 for calamity. So you can imagine, I mean, how knowledgeable we were to offer such a product. And of course, it did okay, but then again, the claims started coming in. We said, okay, let's adjust it a bit. Let's not charge too much, but let's increase it. So it went up from $5 to $8 a year. It's still the same coverage. And of course, when Haiyan came and the successive typhoons I talked about, of course, we bled through because there was so much. So what do? There was so much demand for it. It was low margin product. It was bundled. It was very attractive. The expenses were there. Now we controlled the expenses because we didn't have adjusters. As I said, we trained the people on the ground, whether they were micro agents or whether they were our partners on the ground to do adjustments. So there was immediacy. There was that we sort of adjusted the price when we could, but 5 to 8 is not a real adjustment. And so towards the end, post Haiyan and all of that storm, we committed to do a review. We reviewed, we said we have to redesign, not just reprice. And as a result of that, we have a new product that still had a lot of that, but it had reduced coverages in calamity because that was causing a lot of the losses and the costs, etc. But we also added coverage for the family, for burial, for accident, just to balance it. So there was more people covered as well. But as a result, this product didn't, whereas it looked a bit like the old one, it was completely differently priced. It was now $40. And so what did we do? We said, okay, they're certainly, they can afford $5 in one go, but not 40. So what we did was we convinced and we worked with our partners, the MFI, to say, why don't you give out a loan for insurance? You give them a loan for just about everything. Why not a loan for insurance? Now, they can't afford to pay $40 in one go, but they can afford to pay $1.50 a week. And that's what it was about. And so that adjustment makes it affordable for them. And it's also a better deal than giving it to them on a monthly basis. Because, once they get a loan, it's fully covered for a full year. But if you allow them to pay on a monthly basis, the moment they miss one payment, it lapses. And number two, on certain coverages, there is a waiting period. If they lapse, they have to start the waiting period all over again. So, yeah.
Great. Thanks, Lorenzo. The next one's also for you. So how long did it take for Pioneer to start posting a profit on its microinsurance products? That's a question from Edwin. And then I'm going to take one more. Let me find one that I can give to Quentin. So from Azika, shrinking disposable income is a reality in emerging markets. How have you gone about increasing the usefulness of these inclusive insurance products so that they remain valuable enough to compete with other household expenses? That's a great question. All right, Lorenzo, over to you.
We started in 2000. Our first full year was 2008, and up until 2013, we were all right. Nothing magical. Maybe break even. A slight profit in some years, but nothing great. Enrollments between 28,000 and in 2008 to less than 1 million in 2013. It was really when we had very bad years of 2013 and 2014, successive earthquake and typhoon and storms and flooding, and we kept paying claims, that the magic happened, that we reached our tipping point. And the following year, what happened was that word of mouth, through sheer word of mouth, enrollments doubled from over 1 million to over 2 million. And partners we were trying to woo over, who already had existing partners, became convinced that we were the partner to be and transferred over. And since 2015 onwards, it's been sustainable, profitable, you can call it, or sustainable through and through. And so, yeah. So I don't know if that answers the question.
And on the one on shrinking household, the shrinking household available expenses and budgets, I think the question came from an emerging market kind of scope. The reality is probably worldwide for many people. Of course, it's not the same level, but you have the strive of value for money everywhere. And we have it here as well, even on home insurance, which is here it's a must-have. It's 99% of the population who's insured, but we see people who are giving up on it. I guess there's no real secret in value for money, right? In insurance, how do you maximize the claims that you're paying legitimately to people and reduce the cost of handling, the misfortunes of the few in order to kind of neutralize and share them with the fortunes of the many. I guess that's really the principle of insurance. Then, from a marketing attractiveness perspective, once you find the right equilibrium, and we discussed a lot about how to find this equilibrium in costs and claims, etc., how do you manage to sell and market in order to remain attractive? I guess, three things come to my mind. The first is, you're never replacing people's other risk management strategies. People are, even if they're not insured, that doesn't mean they don't manage their risks very well. They probably rely on some degree of savings. They rely on, community or family help. Maybe they have, lent money to other people. So try to understand this and see where insurance can make a difference versus, trying to solve everything, because there are some risks where insurance is great. It's usually risks which don't happen often and have a high impact. And there are risks where insurance is a very bad risk management solution. Typically, things that will happen in the year. Well, why would you insure them, right? So complement existing risk management strategies. Second, we discussed it, but I think bundling different types of covers makes a lot of difference. People don't care if you're a life insurer or general insurer. They care about their risks. In Burkina Faso, we're insuring shea butter farmers. It's a combination of covering, the crop and covering the farmers. It's crop and health, and that gets you the value for money. And maybe one last thing, which we've seen to be very efficient in a country like Nigeria, for example. Now we market the health policies that we have there, also based on the services that are included. So the ability to chat or phone up a doctor, etc., or to get drugs delivered. Sometimes that's very appealing, and that complements also the attractiveness of insurance.
Great, thank you both so much. Lorenzo, yes, you want to add something quickly?
Yeah, all of that Quentin says, yes. But for us to make ourselves relevant as insurers to that market where everyone's fighting for the share of wallet, we need to make insurance relevant. And there's no more relevance than to pay claims when they file it, legally, etc. Because that is the only value proposition they will experience. It doesn't matter how great the product is, but if they've never had a taste of it, it's not going to help cement our credibility in front of them. And that's why whenever we launch new products, we secretly pray for some claims to really come in so that you can have it tested, people can talk about it, and they can post it, and you can actually say, it works. Look. So, yeah.
Yeah, the moment of truth.
It should be taught in every insurance school in the world. And you mentioned it, Lisa. Lorenzo wrote a book. I highly recommend it for those who are starting in this space, but even those who've worked for years. I've learned so many things in that book.
Fantastic. So wonderful discussion. I'm really sorry we're going to have to end it almost, well, in a few minutes. So thank you everybody for giving us your questions and facilitating this discussion with all of those great questions. We do want to keep these webinars to roughly 1 hour because we know that everybody has busy days. But just before you go, I have a few other things that I want to share with you. So hopefully you will see my slides again. You can see my slides? Lorenzo? Yeah, okay.
Yes.
So this was the first of a series of 6 webinars, as I mentioned. So we have our next webinar coming up in April. The idea is that these webinars are every other month. So our next webinar is going to be on the topic of improving distribution models and partnerships in inclusive insurance. So super important for scale. I mean, distribution is absolutely vital. So we have some great speakers from Seguros Bolivar in Colombia, Vision Fund International, and Intellicava Insurance intermediaries in Kenya. So please do join us. We warmly welcome you to this. Sarah is putting the registration link into the chat now. So if you want to make sure that this is in your calendar, please register now. The other thing I wanted to tell you about is that each of these webinars is linked to a briefing note on the same topic. So watch out next month. These briefing notes will come out 1 month after every webinar. Watch out for our briefing note next month, which will be on improving profitability and financial sustainability. We will publish it on our website from the side of the ILO and the MiN. But also we will put it into our newsletter and put it on social media. So Sarah will put in the chat the link if you want to join our mailing list. But very, very importantly, please, we would love to have your feedback on this webinar. So before you look at the other links, please, 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 it means a lot to us to have your feedback. We listen to your feedback. We use your feedback.